Hello friends, welcome back to another Go charting video. In today's video, we're going to discuss how we can identify absorption. To start with, what we're going to discuss is how do we identify in multiple time frames. So the one that is here is 3 minutes. You can even do it in 15 minutes. So we'll go on and discuss about each time frame, and you can use it for scalping on lower time frames, 3 minutes or 1 minute, and even for intraday trades, that is for 15 minutes and above. Now, the first thing that I'm going to do is I'm going to tell you what type of chart I have. This is so because a lot of you guys have confusion. So this is a cluster chart where I have switched on the imbalance mode as well. And on the left side, that is over here, I have the volume that is shaded in, orange and white. So wherever there is a high cluster of volume within a bar, it will be dark orange and the others will be white in color. So I immediately come to know where the volume transacted is higher. And similarly on the right side I have a delta profile. So the right side, you can see it is showing a profile rather than only the color, and it is set to delta. So you can see the volume on the left side and the delta profile on the right side. The other important thing that I have switched on is the imbalance. So the support and resistances are plotted by this magenta and blue, if you can see, and the ratio has been set to 400. The important thing about this part is that whatever you keep, it can be 300 to 500, and number of imbalances can be 2, 1, depending on whatever ratio you choose. It has to be consistent so that whenever you are trading, you get consistent results. And I've been following this for a lot of time, so that is why I stick to this. And the only thing you might, with the change in volatility that you can do is change the tick size that is over here. So you can go and change the tick size right here. So it is right now at 40. That is every this block is printed for 2 rupees. So like the least count for us is 5 paise, and that is why it comes to 2 rupees. Now the other part is that when you do this, the imbalance is 400%. What it essentially means is the diagonal ratio. So if this is greater than 400% or 4 times, like 8 into 648, so it is greater, that is why it's printed red over here. Now another question which a lot of you guys have is, why do we look at it diagonally? Because that is how the auction works. In any place, even in your depth of market, if you see, or the order book in your broker terminal that you see, when you see the best bid and ask like this, okay, it is always not on the same price. What I mean to say is that the left side is generally that this price is generally less. For example, you have a stock and you see the best bid and ask, so it will be something like this, 115.2, and the other part will be 115.3 and something like this. So this will be lesser than this. So essentially on the same line, same prices are not plotted in a footprint chart. So although in the market depth it is plotted like this in the same line, but the prices are different. It is because this is best bid and best ask, that is why they plotted on the same line. However, when you do it on a chart like this, so on the same price, they are not plotted like this. So at this point when you had 53, the buyers at this point were -8. That is why, this is delta, so it could be 8. So that is why we look at it diagonally. Okay, so if you still have doubts, you can go into one of my videos where I've discussed the basics of order flow. If you still want more clarification, we can do it some other time. Just comment below and we can dwell into it later. So now what we have done is any 3 consecutive, like over here, imbalance zones or imbalance blocks will print a support and resistance line like this. So to start with, we'll discuss the very basics, the quite elementary thing which is still very powerful you can use. So when you have something like this plotted on Go charting, what you can simply do is, this is the last trading session, that is Friday, you can simply go ahead and contract it using your mouse or whatever, or the minus from here. Now this is mind you, this is a 3-minute chart. So when I'm looking at imbalance zones from a 3-minute chart, I'm looking for a scalp, that is, I will look for look for targets that are within the 3 minutes. So for example, if I'm looking at whenever this comes here, when I'm looking to short it, whenever it comes here, I see something, so I will not look more than 10-12 points, because the validity of this zone can be more, but I would rather have it my expectations limited to a 3-minute time frame. Similarly, when you shift it, for example, let's shift it to 15 minutes, you will see something even better. So the validity of the zone now becomes worth 15 minutes. Okay, so when you see something like this, and the first time where this happened and it approached, this was the first time it approached over here, and you can see you got a good fall. Of course, we're not expecting something like this, all the time, but you can get, I mean, almost half of a 15-minute candle, so your target becomes 20 to 25 points. Now by this I don't mean you immediately step into a short trade whenever it reaches the first time. You need confirmation, but more often than not this will play out 70 to 80% of the time. So if you just contract the chart and back test, you will find great evidence in that. For example, this part, as soon as the market comes closer to this zone, it gives you I mean breakout, and similarly on sell zones. Now when you look at this chart, why have I switched on this chart? To tell you the difference between absorption and continuation. Now these are two concepts which really have a lot of confusion in people's mind. Now whenever on the extremes, when you see, by extremes we don't know when the extreme is forming, but something like this, when we see the candle open and on the top of the bar you see this blue zone being plotted, okay, so that means there was aggressive buying at this place, but the bar closed below this. So this is an example of absorption. That is, there were a lot of buyers that wanted to take the price high, but someone stepped in from the other side by means of passive selling, and they absorbed everything and then thereafter stepped in aggressively to take the market down, which happens here. Okay, so as you know, this is a 15-minute time frame, so this point holds significance to us. So if you see, when it comes the first time, it gives us a good short trade. Similarly, this was because of the selling that had happened here, and similarly you see the buying that steps in over here. Now this blue zone is called aggressive this is called absorption, like we just discussed, because there was a lot of buying that tried to take the market up. It failed and the market moved down. Now on the other hand, if you see these places where the price took resistance on maybe 7th, and this was a reason. The reason was that there was aggressive selling on this side. Now this is not absorption, this is called aggressive selling, and you can say delta continuation. Okay, so why is that? Because it is not on the extreme for the first thing. Okay, it is not on the end like this part and the bar doesn't close. It is somewhere in the middle. Now this rule is not sacrosanct, but it will help you a long way when you go on and find zones. Okay, so within a bar they have stepped in and the aggression was so much. You can see the length of the bar. Okay, and if you look at the volume, it will be generally a lot higher. Now you have to make sure whenever you see these imbalance zones, more often than not they will be plotted on big volumes, but that is a criteria. So you need to be having high volumes when you see these, especially 3 imbalance zones. These zones really then work if the volume is above average for you. Okay, the other way you can do it is what in Go charting, it will simply be plotted in a darker shade. If you go here, we'll see the area that we were just discussing. I think this one, yeah. So what it will do is any imbalance zone that you see, so it will be plotted with above average volume. You see darker shades of gray is where the volume was extremely high. Of course this was the open. So this is how you can see it on Go charting, and it is not that difficult to plot out. Even if you miss out in the first instant, you will generally see areas like this being plotted with high volume. So this is the bar that we're talking about, and this has a significant amount of volume. If you look over here, this is the bar. Okay, and this has been caused by so much of aggressive selling. Now this is, as I said, delta continuation. The other thing we'll do is just switch off the VWAP so that we can see things clearer, and we'll just switch this off. Okay, now the 2 examples what we have seen is, this is called aggressive selling and this is absorption. Okay, now both of them work equally well. What is the difference? In one is, these things will generally happen at places where you think the market is going to break out and it doesn't, and when it fails absorption, it generally indicates there will be I mean on a 15-minute time frame, for example, it might test the other support resistance zone. So the other zone that we have below is this one. So this becomes a very good trade if we are looking for an intraday trade, as in the next zone comes almost, if you see, almost 200 points below. So this is something that you can use in an absorption trade when it happens on the upside. Now you have to make sure that you find something of a sort of a confirmation. The other thing that you get in an absorption sort of a trade is good risk to reward. That is why sometimes it makes sense to short here or here whenever it approaches the next time. because the risk to reward is just this much, if you see, and the 1:2 or 1:3 is what you expect. Now, contrary to this, like we just spoke, this is absorption. Now, on the sell side, if you want to see absorption, it is a lot of sell orders on this extreme side. So if, let's see if we can find something. This is again an example of delta continuation. So you can just keep seeing how well this plays out every time. This is again, now this is an example which is very interesting. You've seen aggressive buying. Now this is delta continuation, not absorption. The market goes up, and the next time the market just opens gap down. So obviously these buyers were absorbed in the sense that they've not even been able to hold it for one day. But the next time the market approaches it over here, somewhere here, you see an absorption, and the market immediately goes down to the previous buy level that is here. So even if you use this particular tool in as simple as we are discussing here, it is quite powerful. Okay, and if something like this happens, when a bar opens gap up and it closes above it, this actually nullifies our report. So this, I mean, our analysis or the imbalance zone, because of the way it has opened straight away. So what it indicates is all these sellers have been absorbed in the initial 5 minutes or 10 minutes as well. And the next resistance, of course, becomes this zone that we are talking about. Okay, so the next example what we want to see is of delta absorption on the sell side. So this is one, if you look at it. So the bar opens here, if you see, and a lot of sellers have been absorbed over here. You see the red one, and you look at the volume, they're quite high, and the next bar can't even close below it. If you actually go deep into it, into the footprint, which we're going to just discuss in a short while, so that you can understand what goes on within the bar as well, we will see something really interesting. Okay, so the other thing that I generally use is the POC of the bar and the volume that I keep plotting, and we've discussed this previously also. So one thing that you'll find common among these absorption trades is the delta blocks. So whenever you see absorption on the sell side, look at these delta blocks. Okay, look at the red part that is here, look at this red part, and all the volume accumulated in this zone, and the price on both the bars doesn't close in this zone, it closes above this zone. So this is a very, very good trade on the long side if you're looking for intraday trades, either here or here, and the stop loss being this one, and 1:2 is your risk reward. So this becomes a very, very good entry point when you see delta blocks of all these sellers, okay, on the extremes, where you see an imbalance zone like this, and the bar not even able to close below it. Now this is a 15-minute chart, so of course what you're expecting is at least 100-120 points on Nifty, which is quite acceptable these days. Now if you shift to a 3-minute time frame, like I said, the targets have to be realistic, as in you can expect only 10 to 15 to 20 points depending on where the zone is. And as we all know, the lower the time frame, so if you're expecting 100-150 points in 15 minutes, you have to divide it by 5. So it is 10, 15, 20 points is maximum that you can expect if you have a 3-minute chart. And the longer the time frame, these charts, these imbalance zones work, I mean, the probability is higher, of course. Okay, but in scalping, again, we have other indicators or other rather footprint nuances that we look into. So this particular one is very, very powerful for intraday trading. Okay, so now let's get into the bar, and like we discussed the two differences about the absorption and the delta continuation. Now let's get into each of these bars. So you can see when these zones are, the confusion arises when these zones are like this, stacked, one after the other. So this is a zone where you actually need to take a trade, and of course it plays out. But where do you take a trade? This is where it becomes really important, is because it finally does end up giving you a trade, but from the last one again. So what you have to look over here is these zones. The last one is good, but the volume is the only part that will play a good role in deciding whether you want to take a trade on the long side. The other thing that generally I pay heed to is the delta blocks. So for example, over here in this bar, if you see, the volumes are good, but they aren't that good, and you compare it to this one. So this is a block where I would have actually enter the trade, this one, but the only thing that would have stopped me is there is no delta block, something like this. So this bar did have volumes and did have a delta block. This is a good zone, but this one didn't have a delta block, although I would have entered here because I see a good amount of volume, and this zone is not like we just discussed. Both the bars fail to close below this zone. If you would have liked, you could have actually taken a trade even here as well. And if you look at it, the same thing happens, the bar closes. So whenever you take a trade, if you look at it, you get about I think 60-70 points over here. Okay, on the other side, of course, we're looking for 100 and the other zone on the upside. So so the next target generally which I look for is on the upside POC. That is somewhere here, which again becomes this is one which is the previous day, or somewhere here where the zone is where we see a resistance of sorts. So you can do that, but of course this one wouldn't have given us 1:2 or 3. Of course 1:1 is what it could have given us, and the stop loss again becomes just this zone or this zone if you're taking a trade somewhere here. So the criteria is the same. It generally gives you a very, very good probability trade. So all these zones, even if they don't give you 1:2 or 1:3 rather, they will always give you 1:1.5 and 1:1 at least. Okay, so 50, 60, 70 points on a 15-minute chart is what you're looking for. Now this zone, of course, is a little bit confusing in the sense the bar doesn't close below this delta block like we've been discussing in all these bars, and the other one also closes here. So this was the end of the day. Of course, in the last 15-30 minutes is what you need to avoid. The next day, what happens interestingly is that something like this happens. It opens above this zone that we've spoken about. It takes resistance there. So this is very important, and of course during the first 5, 10, 15 minutes it's difficult to plot, but when we see something like this happening, it gives us indication that the market is going to be strong enough. So it is not essential that you enter a trade here, but keeping in mind that you do not have to enter a short at this point because you have a buy imbalance straight just below you. And finally you can wait for this zone to be tested and like somewhere here, and then you take a trade. Again, this one 724, and it again gives you 70 to 80 points, and the first target again becomes this POC, or whatever you find an imbalance zone that is closer depending on your risk and reward. So you can keep plotting this. And the absorption trades generally work out really, really well. The delta continuation trades is something we'll discuss a little later in the next session, and the ways we can go about to see and trade delta continuation on a 15-minute chart. You can use the same concept on a 3-minute. Just remember that 3 minutes the probability wouldn't be as high like we have here, which is very high and good risk to reward. 3 minutes time frame is for scalping, and you generally, even a 1 minute is for that, and you generally have to keep your risk reward 1:1.5 because the volatility these days is quite high, and you cannot expect risk rewards that are similar to a 15-minute chart. So hopefully I hope this video was of some help to you guys. Until next time, thank you, bye bye.